Bismillah ar-Rahman ar-Rahim wa salatu wa salam ala Rasul al-Kareem. Assalamu alaikum and welcome to Fiqh al-Mu'amalat online course. And today, as a continuation of the discussion we started on the differences between Islamic finance and conventional finance, and we have covered the differences between Islamic banking and conventional banking, and today we move to the Takaful. Of course, there are some common features between the Takaful and banking. We may have some overlapping a bit because at the end of the day they are both Islamic institutions, so there are some common features. But despite that, the overlapping, let me highlight the major points. So the first one is non-compliance to Sharia rules and principles. This is for insurance, meaning insurance doesn't comply with Sharia rules and principles, as there is no mandate for the institutions of insurance company to comply with the Sharia requirements in providing their services or products. When it comes to Takaful comply with the Sharia rules and principles because they have a license. They are holding a license to provide Sharia compliance in the context of the Islamic insurance, meaning in the context of Takaful, which is based mainly on protection, saving, and investment. So whatever policies cover investments, protections, and saving will be under Sharia compliance rules and requirements. The second point is that the exchange contract based on buying and selling in the conventional insurance. Insurance business model is based on buying and selling. It is based on exchange contract, which means that the institutions of the insurance is selling policy, meaning that the participants or the policyholder are buying insurance. Hence, the relationship between the insurance company and the policyholders is based on a Aqdul Baya, contract of sales, which is an exchange contract. And for that reason, basically, the gharar is not tolerated. As you know, there are rules in Sharia, among the prohibitions of Sharia, discussed in the context of the kafir or even Islamic banking in general, that the gharar or uncertainty is not tolerated and it is not allowed in exchange contract, and this is one of the reasons of the prohibitions of the insurance business. Whereas in the Takaful, the contract or the underlying contract is based on tabarru. So tabarru contract is the main contract where Takaful is built upon. So core business in insurance is an exchange contract based on sales. Core business in Takaful is a tabarru contract based on a donation. So that's the two main differences. And as a result of that, you will see that tabarru contract accommodate uncertainty, accommodate gharar, accommodate lack of information, and so on and so forth, because this is a common features when it comes to the tabarru contract, and based on that, the business model of Takaful is valid. And this is the most crucial part when it comes to the business models between insurance and Takaful, and this is the most important points when it comes to the distinctions between the two models. The other features are basically as a result of this feature. Hence, if the insurance company wants to make their business Sharia compliance, what they have to do, they have to give up the exchange contract, which is the sales-based model, and shift to tabarru contract and subscribe to the donation model. Their business will be Sharia compliant. So the core and the main differences that created clear distinctions between the two models is basically the underlying contract that govern each of the institutions. Insurance is based on exchange contract sales, and Takaful is based on tabarru contract, which is tabarru. And the other features are basically implications and impact as a result of these core requirements. The other point is that, of course, as a result of this, the other point is that in the insurance company takes the risk and liability. So basically the insurance sells policy, and as a result of that, they will take the liability and take the risk. Meaning the company itself will assume a position of guarantor and take risk and liability. So when it comes to the Takaful, it's not the company, but it is the participant that guarantee each other, not the takaful operator. Takaful operator will assume positions of wakil, will assume a position of fund manager, and the participant among themselves guarantee each other when it comes to whatever potential risk coverage or any potential claims. So it's not the takaful operator is the guarantor, but the participants are the guarantor, and the takaful operator just act as a wakil. The other features is that the claims paid in the insurance company, the claim is paid from the company funds, meaning the corporations, the insurance company pay the claims from its own pockets because they have assumed a position of risk taking a liability, whereas compensations is paid from the takaful fund in the takaful. In the takaful, the money it is not paid from the pocket of the takaful operator, but it is paid from the risk fund or from the takaful fund. The other features is that the insurance company owns the funds, meaning the funds belongs to the company. Whereas in the takaful operators doesn't own the fund, but just manage the fund. So insurance company own the fund, takaful operator manage the fund in the capacity as an agent or as wakil. The other feature is that the asset of the insurance companies are invested in non-Sharia compliance assets. Well, they can, of course, invest in Sharia compliance assets, but there is no mandate to do so. They may invest in Sharia compliance assets and they may invest in conventional assets like bonds and conventional stock and so on and so forth. But when it comes to takaful, the asset of the takaful and the funds of takaful are invested in Sharia compliance assets as a mandate, meaning they don't have the choice. In other words, they are not allowed to invest in non-Sharia compliance assets, and this is one of the differences that basically make the return and the profit generated by the takaful operator as a permissible revenue Sharia compliance profit. And the other features is that, of course, in the context of Malaysia, when it comes to the regulation, it is governed by the FCA 2013. When it comes to the takaful, it is governed by the Islamic Financial Services Act, IFSA 2013. Of course, this is in Malaysia and other jurisdictions, so it depends what kind of the law that may govern banking or takaful or Islamic capital market. And the last point we would like to highlight in this session is that Sharia board is not part of the corporate governance structures of the insurance, meaning they have the board of directors and they have the management, but they don't have this external Sharia board that may guide them on some kind of compliance requirements. They don't have these structures. But when it comes to the takaful, the Sharia board or the Sharia committee is part of the structure of the Sharia governance, and not only the Sharia board or the Sharia committee, but other corporate governance organs as well, like Sharia audit, like Sharia review, Sharia board and risk management and so on and so forth, whereby they have the responsibility to ensure that the business of the takaful operator is in Sharia compliance, where they provide guidance, resolutions, and so on and so forth to ensure that the takaful operators are operating according to the mandate of the license, which is offering a business and policy in the context of protection, saving, and investment according to the Sharia requirements. So this is the, I may say, the most key features that make a mark or create distinctions between insurance business and takaful operator. With that, thank you very much and see you inshallah in the coming sessions. Wassalamu alaikum wa rahmatullahi ta'ala wa barakatuh.